Good morning. It's Friday, March the 12th, and welcome to Market Insights with Mike. We are solidly into the new year. We're only just a couple weeks away from the end of the first quarter, and we're moving right along. A lot of things have happened this week. Last week we talked some about inflation. I'm going to touch on that for just a second. I know that, I watch our grocery bills, and I know that our costs on groceries have gone up, but I think it's offset by eating out. Obviously, none of us have been doing that too much. But I do know, and there's a lot of conversation about the price of gas and what that's going to be. There were some reports in the last couple of days that they thought the fuel would start being $3.50, $4 a gallon by the beginning of summer. And gas is one of those things where it's not elastic, it's not inelastic. Those are economic conditions where the price and demand kind of determines where things are going, and they walk hand in hand or not. And gas is kind of interesting because you got to get to work, and so whether the price is $2 a gallon or $2.50 a gallon, you still have to have the gas in your car to get to work. So that would make it relatively inelastic. However, the elastic part would be I decide to go on vacations or not. My point there, my concern, is that the price of fuel going up early in the summer, there's a lot of pent-up demand for travel. There's a lot of folks that want to get out. So it'll be interesting to see how the price goes and how the country reacts to that. Do they just say, I'm going no matter what, and build that extra cost into their vacation, or do they just say, hey, we've been sitting home for a year, another couple of months isn't going to hurt us? So we'll kind of have to keep an eye on that and see what that does, particularly to travel and leisure. I think that's a possible impact. You've got Jerome Powell still talking a little bit about inflation, but they still don't intend to do anything about it. And that's fine. Where we are right now really is manageable. It's really not too much of a shock, so it's not a big deal. So those are just two items going forward of the many things that we try and watch that we're keeping an eye on. So let's go ahead and get right into it. Mallory's behind helping again, and here's our Dow Jones Industrial Average. And remember, this marks the 1 year point from when we really started seeing COVID shutdowns. That was about a year ago this week. That's when I think the SEC conference was canceled. So there was a lot of sporting events starting to get canceled a year ago today. And you see this big dip here in March. We've talked about that 100 times. That's March 23rd, March 24th. And you're going to see a really odd phenomenon, because as we do our rolling 12, that number is going to look really exceptional when we hit the last week of March on how we've done the last 12 months. But the fact is that we're coming out of that dip right here down to about 18.5. And today we're up at 32,400. So it's really been an incredible couple of months since the bottom, the pit of the COVID. And you can look at that recovery, it's just incredible strength. And we talked early on, if you look back to some of the earlier reports where we talked about a Nike recovery, a swoosh, and holy smokes, this is almost an image of a Nike swoosh right here. So we're seeing that. We talked about the possibility of a double dip. We didn't see that. The early on forecast of a Nike swoosh was incredibly accurate. That's what we have. So that's where we are today. That's our moving average, not in bad shape. And I'll talk about it in detail in just a second. I think this is the next slide, Mallory. Yep, this is the movement over the last 2 weeks of the Dow, which is the aqua color, the NASDAQ is the orange, and the S&P 500 is the purple. Those are daily percent changes. So you can look right here as a 0% right there in the middle. The previous week, we were down all week. And look what's happened in the last couple of trading days. Obviously, there was no trading on Saturday and Sunday. Those kind of filled in, but look at those numbers and what they've done this week. It's just been an amazing week for us, and we'll go into detail in just a second. But what I wanted to show is what we've done the last couple of days and where we've been. So you're looking at that NASDAQ number where it popped up almost 4% in one day. That was Tuesday the 9th. Pretty big day. So the last week was kind of boring. Not a lot going on. It was a down week, but I don't get too excited when you have a down week. But this week has been exciting. You see some great things going on there, and that's kind of cool to see. You see the strength of the economy, and that's nice to see. So Mallory, next. This is our U.S. sectors, and again, we have those things that we've always paid attention to. And recall, we looked at gas and energy. We had a terrible year with gas and energy. Gas right now, or petroleum, is up to about $60 a barrel, a little bit over that. So the year-to-date performance is up 18.3%. It's leading all the sectors. That is not unexpected at all. It got beat up so bad, and gas and energy, those are things that kind of have to happen. There are three things that will always be in demand. One is utilities, one is financials, and the other one's healthcare. Those are the sectors that will always be some demand. It's just they tend to be relatively volatile, and they tend to have cycles that we have to work in. Utilities are down on the trailing 12. That's not too much of a surprise. Technology, the interesting thing about technology is what it did in 2020, which was up 46%. And remember, about a month ago, we said we were paring back technology because we felt that after 8 years run, maybe it had run its course, or we just weren't convinced that it could do another year again like it had done the previous 8. Right now, year to date, 7.2%. That's okay. It's not great, but it certainly is not on pace to repeat 2020, which is kind of what we were looking at. And we'll just see how accurate that forecast is as we go through it. Everything else is kind of in line with what I would expect, with one exception of telecommunications. There's some things there that are a little bit surprising. Telecom should be doing better considering that it is everything on how we talk right now. And any This Is Us fans, it was just a really cool episode 2 weeks ago where they brought in the guy that had created the technology we now use for Zoom. It was just a super episode. If you have a chance to go back, that goes back into the time where this guy came up with the algorithms to create the ability to put pictures on phones. Cool episode, but that's what all telecommunications is about. And that's how so many of us are dealing with it right now. So this is interesting, and Mark and I have adjusted our percentages on the sectors, and we're watching that going forward. We'll make another adjustment around Memorial Day. Next. This is the world markets. There's 2 columns here on the far right to look at. One is on the far right is the versus last week. And then you can see when I just talked about a second ago, the 3 US indices at the bottom versus last week, we've had a really solid performance, up 3, up 3.7, up 2.5, pretty good. But what I'm really happy with is that second to the last column, which shows percent year to date. So that's December 31st closing to the closing last night. And you can see almost across the board, everybody's doing okay with the exception of Australia, who's kind of lagging. And my concern at the UK, which was inflation, actually recession in the UK, I'm still seeing it being kind of a laggard, but maybe them coming out of being locked down is coming up here shortly is going to help. But a 4.28% for the year is actually pretty good for them. They were up 1.6 for the year, or for last week. That's good to see. We really don't want to see the UK drop into a recession. We want them to stay solid. So these are your numbers for the world. And I think generally, if you focus on that next to last column, which is year to date, we're all doing pretty well. It's a global economy now, and we're all moving right along. The great part is there's the US indices out there pretty much leading the pace. So that's great. Unemployment claims. There was a drop in unemployment claims. That's actually really good news. I'll still have a caveat about that. That number is still far above 200,000. The number was 717 this week. So we're getting that unemployment average, that orange line, is being forced down a little bit. It continues to be forced down from the high of the moving average, which was in May. And you can see that blue line keeps kind of working its way down below. And what we really need that line to be is to back down where it is over on the far left-hand side, which is about 220,000 filings a week. That's normal. And I've said this before, I know that sounds a lot, but that translates to about 4 to 4.5% unemployment, which is essentially a full force economy. So when you talk about people in transition, people that don't want to work, that 4 or 4.5% is, 5% is fine. So we need that line to keep coming down, and it's working its way down. We'll just see what happens as we come out of this the season. This is the volatility index. This looks so much like an EKG that it kind of cracks me up. You see, we had that big bump we talked about last week over on the far right-hand side. And so you have these little heartbeats pop up where it's reactionary. And remember, this is a daily movement. So because the Dow and because of the NASDAQ and because stocks can be so immediately accessible by everybody, there sometimes is immediate reaction to what's going on. You saw that when at GameStop, you see that in a couple of stocks. So the volatility index is going to be like this. It's going to look like an EKG, like somebody's heartbeat pattern. And it's a matter of making sure that we identify when we see those pops on the 7-day moving average and the 14-day moving average. But if you look at the 14-day moving average, you can see that it's been kind of stable for quite a bit. And that's great. We want to see that. Even better, as I've said before, if we could get that daily number down to 10, that would be awesome. and we'll see what happens as we move forward. But volatility is something that we really have to pay attention to. Next, Mallory. This week coming up, we actually have a lot of activity coming up this week. On Tuesday, we have retail sales, the import price index, which is a big deal. My concern obviously is our debt. I'm not going to quote the number. I know what it is today, but it's huge. We're talking approaching, we're trillions of dollars. National Association Home Builders Index and business inventories, all those are important. There's a lot more reports coming out. Those are the ones I want to read. And then Wednesday is housing starts. That is going to be a big deal to see if we're still tracking in that direction. My concerns housing going forward are the price of lumber, which is now $1,000 a board feet, incredibly expensive. And then Powell has a press conference scheduled for Wednesday. He's been making comments in between, but his formal conference is scheduled for Wednesday afternoon. Thursday is the Philadelphia Manufacturers Survey. That's a cornerstone for what's going on in manufacturing index. And the index of leading economic indicators, that's for us, gross domestic product and things like that, and then business inventories. There are a lot of reports coming out. These are the core that we will be watching next week and reading as close as we can and looking for some indication of where we're going to go in the next quarter and certainly between now and the end of the year. And then the Powell, any comments he may make on Wednesday regarding inflation in particular, but also regarding interest rates. Our concern obviously is, are they going to do anything about it? They've promised or not, and they're just going to let them kind of run where they are. Inflation and the interest rates. We'll have to see if they think it's time to do something for the economy and change some of their methodology on what they're going to do. So we'll see how that shakes out next week. These are the things on the calendar. Sunday is daylight savings time. So everybody spring forward, change the batteries. My 15-year-old son has all his batteries ready to go. Tomorrow he's going to change batteries and everything. Spring break week for most of us is the 15th to the 29th. We have the FOMC formal meeting on the 16th to the 17th, and it's obviously to some of us, St. Patrick's Day is pretty important. That's coming up. End of the quarter is March 31st. We've talked before, Good Friday is coming, the markets are closed. And just to kind of prep everybody, Mallory and I are going to be doing some vacation time, some time off, some remodeling what we're doing and kind of improving our technology. We're not sure when we're going to be able to start that project, but it'll be sometime in the next probably 14 days. And we'll be kind of suspending what we're doing on Fridays until we get through tax season. And then we'll be back with a bright program, shiny, same distance, same time, 15 minutes. And our goal is to bring back with a little bit of improvement thanks to some input from all of you. So that's where we are. We are in the office. Give us a call, 259-2110, area code 913. We're happy to help. Have all of your friends tune in or look at us on Facebook and see what we're talking about. No obligation, no harm, no foul, and we're interested in any comments or questions you might have. So that's where I want everybody to have a great week. Enjoy the rain, fertilize your yard, have a wonderful time, and we'll see you back here in a week. Thanks for joining us. We really appreciate it. Take care.